All right, let's take a look at bank reconciliations. What is a bank rec? It's a schedule comparing the cash balance per books with the balance per the bank statement. So the client does a bank rec hopefully every month, but the one of most importance is the one at year end. So starting with the ending bank balance, the client's going to reconcile to the book balance to reach the true balance of cash, which is very important at year end because that true balance of cash is the one that's going to go on the balance sheet. And it will also be included as the ending cash balance in the statement of cash flows. So we get to the same true balance of cash, but we're going to start with two very different balances, the balance per bank statement and the balance per books. And those two balances will eventually reconcile to the same balance, the true balance of cash. And the bank rec allows the client to determine whether the difference between those two balances is attributable to normal conditions or not. Normal conditions would include unrecorded items due to timing, but then other items that might attribute to the difference might be error or fraud. Any error could be made by the bank, but errors are more likely to be made by the client. So we start with the bank statement balance of cash at the end of the period. Why is that not the true balance of cash? Because of things like outstanding checks, deposits in transit, and possible bank errors. Outstanding checks, these are checks written and mailed by the client before the end of the year, but have not yet cleared the bank. So the client's cash balance per books, they probably have reflected these checks already, but they've not yet cleared the bank, so the bank statement doesn't include these checks when it shows you the final ending balance of cash. Because the client's going to write and mail these checks maybe on 12/29, 12/30, 12/31, and it's going to take time for them to arrive in the mail at their destination and the other party to cash them. What's the chances that a check mailed on 12/29 to another party is cashed by year end? Very little chance of that. It'll probably be an outstanding check. So what do we do with outstanding checks on the bank rec? They're subtracted from the bank balance to arrive at the true cash balance. So what about deposits in transit? Well, a company may deposit a check from a customer on Monday, December 30th, but the bank doesn't always clear the funds the same day, especially if it's an out-of-state check or a check drawn on an account that the bank's not familiar with. The bank will hold that check and they won't give the client credit for those funds until a few days later. So if this happens on 12/30, a few days later, we're into the new year. So at 12/31, this deposit is in transit and it will not appear on the 12/31 bank statement. And that's why deposits in transit have to be added to the bank balance to arrive at the true cash balance. So far we said outstanding checks have to be subtracted from the bank balance. Deposits in transit, they're added to the bank balance. And then what about bank errors? If they tell you in the question on the exam that the bank made an error, then you're going to have to correct the error. The bank may have wrongly charged or wrongly credited the client's account, or maybe failed to record a transaction at all. That error would be corrected by either adding back or subtracting from the bank statement balance. Here's a question on bank errors. In a bank reconciliation, which of the following bank errors would result in the client having to increase the bank statement balance in order to arrive at the true cash balance? So, what error would be added to the bank statement balance? A says the client wrote a check for $100. The bank erroneously cleared the check for only $10. Well, that's a bank error because the client wrote the check for $100. So the bank should have cleared the check for $100, not for $10. So $90 more should be subtracted, not added, because the bank's eventually going to catch this error. So if we want the true cash balance, we'd have to subtract another $90. So A's out because the question wants to know which of the following bank errors would result in the client increasing the bank statement balance. So it's not A. What about B? Client made a deposit of a customer's check for $100 and the bank erroneously credited the client's account for only $10. So that's a bank error. And when it's corrected, they're going to increase the bank statement balance by $90. So it looks like letter B is what we're looking for. We're looking for a bank error that would result in adding to the bank statement balance in order to get the true cash balance. And letter B would meet that criteria. So letter B is the answer. So far, we've looked at items known to the client but not known to the bank, including bank errors, deposits in transit, and outstanding checks. Let's try this question. In a bank reconciliation, the client receives the bank statement and adds which of the following to the bank statement balance to arrive at the true cash balance as of December 31st. So you got the bank statement. It's got the ending balance December 31st on it, but what do you have to add to that balance? Something that you know about that the bank doesn't. What about A? Checks written and mailed before year end. No, that would be subtracted, not added to the bank statement balance. B, deposits made before December 31st but not credited to the client's account until January 3rd. Yes, B is a deposit in transit, and that will be added to the bank statement balance because you know about it. It's just that the bank didn't know about it, and you would add it to the bank statement balance. That's a deposit in transit, so it looks like letter B. B is correct. Deposits in transit are added to the bank statement balance. The bank statement didn't know that these deposits were made before year end, and they don't appear on the bank statement for December. Outstanding checks, which is what letter A is all about, they would be subtracted from the bank statement balance, not added, because the bank didn't know that these checks were written and mailed before the year end, but you wouldn't add this. Remember, the question asked which of the following would be added to the bank statement balance. Outstanding checks would be subtracted. All right, now we're going to switch it up and go to items known to the bank but not known to the client. And these will come in two different parts. First, we'll talk about amounts already added by the bank that the client doesn't know about. And a big one here is interest income, because if you leave money in the account, you'll earn a little bit of interest, and that amount is known to the bank. It's already on the bank statement, but it's not known to the client until the client reads the bank statement. So this interest income must be added to the book balance, because the bank already knows about it. It's on the bank statement. It's just that in your books, you haven't recorded this interest because you don't know how much it is until you get the bank statement. So the interest income has already been added by the bank. Now it has to be added by the books. Another one would be notes collected by the bank. Sometimes banks act as a collection agent for client notes. So that means the client is waiting for a customer to pay on a note receivable, and the bank collects it directly from the customer. The client learns of the collection when reading the bank statement and adds that note amount plus any interest to the book balance. And now we'll talk about amounts already subtracted by the bank. So these are items known to the bank but not to the client. We just looked at amounts already added by the bank. Now let's look at amounts already subtracted by the bank. And the number one is bank charges. Bank charges are typical. If you have a checking account, a business account, there's probably going to be a bank charge every month in the statement. The bank already knows about that. But in your books, you've got to subtract the bank charges when you get the statement. Another one that the bank already knows about that you don't is customer checks that have been returned for insufficient funds. Customer writes you a check. You recorded it in the books already. You brought it to the bank. You deposited it. And it turns out the customer wrote you a bad check. So you know what the bank did? The bank never gave you credit for that amount. But you gave yourself credit in the checkbook for that amount. When you get the bank statement, you're going to have to subtract that NSF check. They call it NSF, insufficient funds. The client thought that the customer paid, recorded a $500 cash receipt in the books, but the check bounced. The bank knows it bounced and never cleared the funds. Now the client has to subtract that from the book balance because they already gave themselves credit for the $500 in the books. So those are two big ones that the bank already knows about, but you don't know it until you see the bank statement. Bank charges and customer checks returned for insufficient funds. Another one would be errors on the bookkeeper's end. So client bookkeeping errors. We looked at bank errors. Now what about bookkeeping errors? If you do a bank rec, that's when you'll detect bookkeeping errors. And if detected, it'll need to be corrected. The bookkeeping error, it may have added too much to the book balance, or it may have subtracted too much. Whichever is detected would need to be corrected. So let's try this question on bookkeeping errors. In a bank reconciliation, which of the following bookkeeping errors would result in the client subtracting from the book balance to arrive at the true cash balance? Letter A, writing a check for $500 and erroneously recording it in the books for only $50. So with letter A, it looks like you need to subtract another $450. Because you wrote a check for $500, the bank probably cleared it for $500. It didn't say the bank made an error. It says you erroneously recorded it in the books for $50. So that means you probably looked at the bank statement in doing the bank rec and realized the error, and that's going to result in you subtracting $450 from the book balance. So it looks like letter A is what we're looking for, something that will subtract from the book balance to arrive at the true cash balance. And if you write a check for $500 but erroneously recorded in the books for only $50, when you do that bank rec, you're going to see that check on the bank rec clearing for $500, and when you go to your books to cross-reference it, you're going to see you only took $50 off. You're going to have to subtract another $450. What about B? Recording a deposit for $500 when the actual amount of the deposit was only $50. So it looks like in letter B you gave yourself too much credit in the books for that deposit. So you're going to have to subtract $450 because you recorded it in the books for $500 and it says the actual amount of the deposit was only $50. So you looked at the bank statement and you realized the error, and you're going to have to correct it by subtracting $450 from the book balance, making both of these correct. Let's go with letter C. All right, let's try this one. In a bank reconciliation, the client receives the bank statement and adds which of the following to the book balance to arrive at the true cash balance? A, interest earned. Yes, because the bank knew about it, and we don't know about it until we see the bank statement. So we will add the interest earned to the book balance. B, notes collected. That should say notes collected by the bank. Yes, that would be added to the book balance to arrive at the true cash balance because customers may have made their payments directly to the bank and you don't know about it until you see the bank statement. And then you would add the amount of that note to the book balance to arrive at the true cash balance. So it looks like both of these are correct. We're going with letter C. All right, let's try this one. In a bank reconciliation, the client receives the bank statement and subtracts which of the following from the book balance of cash to arrive at the true cash balance? Number 1, Roman numeral 1 says checks received from customers that were returned for NSF. Okay, with that, you're going to have to subtract that from the book balance because the bank statement already did subtract it. The bank knows that it was returned NSF, but you don't know it until you get the bank statement. And then you've got to subtract it from your book balance. So number 1 is correct. Let's go to number 2, service charges. Those are bank charges. Bank service charges are going to be subtracted from the book balance to arrive at the true cash balance. Why? Because the bank already knows about it. It's on the bank statement. It's just that you don't know about it until you see it on the bank statement, and then you have to subtract it from your book balance to arrive at the true cash balance. So 1 and 2 look good, since we're looking for what has to be subtracted from the book balance: NSF checks and bank service charges. What about 3? Interest income. Well, the bank knows about the interest income because it's on the bank statement already. You don't know about it in the checkbook until you see the bank statement, and then you would add it to the book balance, not subtract it. So 1 and 2 are correct here. 3 is wrong, so we're going with letter B. All right, how about this one? In a bank rec, the client receives the bank statement and subtracts which of the following from the bank statement balance to arrive at the true cash balance as of December 31st. This time we're looking for what gets subtracted not from the books, but from the bank statement balance. Letter A, checks written and mailed before year end that clear the bank in early January. Yeah, those are outstanding checks in December, and we know about it, but the bank statement balance doesn't have it on there, so we would have to subtract it from the bank statement balance. So letter A looks good. How about B? Deposits made before December 31st, but not credited to the client's account until January 3rd. That would actually be added to the bank statement balance to arrive at the true cash balance. Any deposits that were made before December 31st, not credited to the client's account until January 3rd, would be deposits in transit. We know about it, but the bank statement balance doesn't have it yet, so go ahead and add that, not subtract it. So the only answer here would be A. So let's go with A, because outstanding checks are subtracted from bank statement balance because the bank statement's dated 12/31 and did not know that these checks were written and mailed before year end but not cashed until January. Deposits in transit, on the other hand, are added to that bank statement balance, not subtracted, because once again, the bank statement is dated 12/31 and didn't know that these deposits were made before year end. How about this one? In a bank reconciliation, the client receives the bank statement dated 12/31 and adds which of the following to the bank statement balance to arrive at the true cash balance at December 31st. So here we want to know which of the following gets added to the bank statement balance. We know a deposit in transit would, but I don't see deposit in transit as one of the choices. What about interest received, letter A? Well, the bank would already have that on the bank statement. That would be added, but it would be added to the book balance, not the bank statement balance. What about B? A check written for $300, but the bank erroneously charged the account for only $30. So here's a bank error for $270. Is that going to result in us adding to the bank statement balance the $270 difference? No. We're going to have to subtract $270 more from the bank statement balance because the bank's going to only find out about this error one day, and when they do, they're going to reduce our bank account balance by $270. So that's what we have to do if we want the true cash balance, and we're starting with the bank statement balance. We're going to have to subtract $270, not add it, so B is wrong. What about an NSF check? Well, a check returned for insufficient funds, the bank would already know about that. That would already be on the bank statement balance. So you wouldn't have to adjust the bank statement balance for NSF checks. You would have to subtract it from the book balance. So the answer would have to be D, a deposit for $300 that the bank erroneously credited the account for only $30. So here's another bank error, but this $270 error is going to be added to the bank statement balance because if you want the true cash balance and you're starting with the bank statement balance, they've only given you credit for $30 for this $300 deposit. So add $270 and then go over to the bank and let them know that they made a mistake, and they'll increase your bank statement balance by $270. So the answer is D. All right, now these next couple are going to be a little tougher. Leonard Corp's bank statement dated December 31st indicated a balance of $10,000. So bank statement balance $10,000. The book balance on that day was $9,000. So obviously the two always start with different balances. The bank statement balance is 10, the book balance is 9. The bank balance did not include $3,000 of checks written and mailed in December that eventually cleared in January. What are we talking about? Outstanding checks. What do we do with outstanding checks? They're subtracted. Subtracted from where? The bank statement balance. So the bank statement balance, we're going to take $10,000 and subtract $3,000 for outstanding checks. So write that down. Now the statement did show that a customer's check in the amount of $2,000 was returned for non-sufficient funds. So there's an NSF check that already showed up on the bank statement like it always will. What do we do with that $2,000? Subtract it from the book balance. Great, so what's the true cash balance then at December 31st? Work that out and leave me the answer in a comment after you like and subscribe to the YouTube channel. Leave me a comment as to what you think the answer is. What's the true cash balance at December 31st? Then get yourself on I-75 and take it to your next pass.